Good morning, everyone, and welcome to this timely session on financial inclusion regulation, challenges for emerging markets and developing countries. We have put together a very strong panel for you, which I'll introduce in a second. I am Babak Abbassadeh, CEO of Toronto Centre, and your moderator for today. And I wish to thank the European Microfinance platform for inviting us to organize this session. And this is the first year that Toronto Centre has become a member of the Microfinance platform in Europe. We were established in 1998 to promote sound financial governance, stability, and inclusion by building the capacity of financial sector regulators and supervisors in emerging market and developing countries. Since then, next year will be our 20th year, we have trained more than 10,000 financial sector regulators and supervisors from 190 countries and territories. There's a lot of challenges in this topic. Most of you are familiar with microfinance challenges from the actual standpoint of the industry, but also there are challenges in financial inclusion regulation. As you've heard elsewhere, 2 billion adults worldwide still do not have access to financial services, and in developing countries, women are the majority of that. Inclusive financial systems are a powerful instrument for promoting gender equality, women's empowerment, poverty reduction, and women's ability to save, borrow, and control their own money and to insure themselves and their assets, reduces poverty, and promotes better health and nutrition outcomes for their families. It also enables women to better contribute to the economic output of their countries. There are studies that show increased participation of women certainly increases GDP. So this makes this session very timely and this week very timely. There's also other issues around innovations in finance, digital finance, that show great promise in expanding services to the previously excluded, especially poor and rural women and men. And these developments help underpin the UN 2030 Sustainable Development Goals, Addis Ababa Action Agenda, and Canada's Feminist International Assistance policy as well. Now we get to the challenging part. While microfinance and other financial inclusion tools can promote greater access to credit, without adequate regulation and supervision, imprudent credit expansion may pose risks to financial stability and consumer protection. So this is one of the issues that the panel will be touching on. And also, global standard setting bodies are incorporating financial inclusion objectives into the international regulatory framework. This has been reflected, for example, in the guidance on financial inclusion issued last year by the Basel Committee on Banking Supervision, which is chaired by Governor Stefan Engves of Sweden, a longtime board member of the Toronto Centre. We also acknowledge the pivotal and catalytic role of the Global Partnership in Financial Inclusion and that of our long-standing partner, CGAP, who are represented today by Tim. And of course, in these efforts, Indonesia has had an active role in the Basel Committee, Financial Stability Board, and other international discussions. And Mr. Wimbo Santosa has been a big embodiment of that, which I will talk about during the introductions. And in addition to regulatory issues, the role of the providers of finance to microfinance institutions and other forms of market discipline in exerting sound governance should also be considered. So every year at the Toronto Centre, we do about 70 programs around the world. A subset of that is what we call financial inclusion and encompasses microfinance, microinsurance, consumer protection, and digital financial issues for supervisors to enable regulators to better build the regulatory system. Toronto Centre's work is generously supported by Global Affairs Canada, the Swedish SIDA, and the IMF. And we also are indebted to one of our original founders, the World Bank Group. I think you have seen the bios of the speakers in the program's website. Have you looked at their bios? Have you seen them? Okay, so I'm not going to do a major introduction of all of them. but I'm going to touch on the relevant background of them here today. Let me start with the order of the panel. Tim Lyman, sitting to my far right, has worked in the area of microfinance and financial inclusion for more than 30 years. So probably a lot more than some of the people in this audience, right, have been on this planet. So he knows a lot about this issue. And since 2005, he has led CGAP's government and policy team as senior advisor with a primary focus on regulatory and supervisory issues in financial inclusion. He's authored groundbreaking publications and guidance on regulation and supervision of microfinance, and works very closely with the Global Partnership for Financial Inclusion and the standard-setting bodies. He's a lawyer and a hyper multilingualist. I think the number of languages he knows exceed the number of digits on my hand. Next to Tim is Pak Wimbo Santoso. He became the chairman of the Financial Services Authority of Indonesia, OJK, earlier this year. Now, for the benefit of the audience, OJK, or the Financial Services Authority of Indonesia, is probably one of the most important and the largest regulatory agencies anywhere in the world. And Indonesia is very important for financial stability in the globe. And the last crisis of 1998, prior to that, Indonesia played a very key role, and the country has improved quite substantially. And they have been a very big partner of the Toronto Centre over the years, and for that we thank you very much. And he's also been Indonesia's representative on the board of directors of the IMF for a couple of years. In fact, represented all the Southeast Asian countries in the ASEAN area, and also was Bank Indonesia's representative in New York from 2012 to 2013. He has worked in the private sector, and also, he has had an accomplished career at the Central Bank of Indonesia for a long period, starting in 1984, including supervision. And so he has a lot to offer in this panel. Ruth de Crivoy, next to me, is a former vice chair of the Toronto Centre, but more importantly, former governor of the Central Bank of Venezuela. She knows a lot about the challenges of developing countries, Latin America, and also as a long-time trainer at the Toronto Centre for over a couple of decades, at least with our organization. She has been intensively involved in training and teaching financial sector regulators. And she was the first person who actually taught me about microfinance. So I very much appreciate that. Hopefully the comments I've made are in line. Next to me, just to show you that everybody in this panel has something to do with Toronto or Toronto Centre, is Dirk Setzer. He's an ADA chair for financial law at the University of Luxembourg since 2016 March. He completed his advanced law degree at Toronto, University of Toronto, and his doctorate at Heinrich Heine University in Düsseldorf, Germany, and taught in various prestigious universities in Europe and worked in the private sector, including a law firm in Toronto. And he's an advisor and part of a working group of several international bodies, such as the European Commission, the European Parliament, ESMA, European Securities and Markets Authority, the German Ministry of Finance, the German Ministry of, and the Financial Stability Board. It sounds very scary. You're involved in all of it. It's like a bit of an international operator. And he has authored more than 150 academic publications dealing with banking, corporate, security law topics, as well as publications on fintech and financial inclusion. So, to stop me from talking, I want to start the panel to talk. And the way we're going to do it, we're going to try to pose questions to them, 3 rounds of questions, and then obviously we'll open it up for Q&A to the audience. Depending on the time, we may stop at the second round and invite you to ask us the questions that you have. So the first round is going to be about an overview. Let me, before we start, get a show of hands. How many people in this room have worked in the regulation of financial inclusion or the regulatory sector? Can I see a show of hands? Okay, so that's great. So that means that others haven't. We have calibrated the session so it would be of benefit to both audiences, and I wanted to make sure that the speakers are also aware of that. So Tim, a fun question. So Financial crisis is about 10 years behind us, 2007 and 2009. We talk a lot about unbanked financial inclusiveness. And some would argue that the last crisis was triggered, at least in part, by the so-called subprime crisis in reckless mortgage lending in the US and UK to borrowers that were previously considered unbankable. So is there a trade-off between financial inclusion and financial stability?
Good question. And I'm really happy to say that this simplistic trade-off mentality that you have more financial inclusion, you have less stability, is the preachers of that doctrine are dying fast. The G20 and its Global Partnership for Financial Inclusion, which Babak referred to already, recognized really back already in 2010 that the linkages among the goals of financial sector regulation are much more complex. And in fact, a financial system, whether at the global level or at the country level, that is only serving a small part of its population isn't doing its job regardless of how well it's serving the rich. So stability for what? Stability for whom? CGAP has been emphasizing since actually prior to, we had a hypothesis that we confirmed in some research in South Africa in 2012, documented in a working paper that looked at financial inclusion policy making in South Africa. And it was a great study case because South Africa, with the change to black majority rule, had specifically undertaken a program of financial inclusion that was quite well documented, and there was a good paper trail to analyze what the results of their financial inclusion policy making were. And we looked at their goal to increase financial inclusion, also their goal to protect systemic stability. They had not all that long before become a member of the Financial Action Task Force, and therefore financial integrity was a big issue of concern for them. And finally, consumer protection. So all these four policy objectives. And we analyzed a bunch of different financial inclusion-related interventions, and really were able to establish that while, yes, there are trade-offs in some situations among these goals, there are also synergies. And the synergies are not actually very likely unless policymakers recognize that this takes effort and conscious attention. The linkages are many and various, and as the South African research showed, it's not just stability and inclusion, but it's also financial integrity, that is keeping an eye on financial crimes such as money laundering and terrorist financing, and really especially financial consumer protection, because in the long run, if we're failing to protect the interests of financial consumers, all of the other objectives are harmed in the process. And in this slide, I think you can look at the subprime crises and say, this is first and foremost a massively destabilizing failure in financial consumer protection, not the result of a trade-off between inclusion and stability. And I'm really happy to say that we've been gaining more and more momentum with this message that these four policy objectives are complexly interrelated, and with care and attention you can work towards synergies among them. Now we've got institutions catching up with us like the IMF, and in fact Christine Lagarde has become one of the most eloquent spokespeople against this kind of trade-off thinking.
Thank you. And also you referred to Financial Action Task Force. For those of you who are not familiar with that body, they deal a lot with anti-money laundering issues and illicit flow of funds, so it's actually a pretty important thing. Thank you very much. So, next question to Pak Wimbo. Indonesia is a country of about 250 million people. So that's a very large country in a very important part of the world. And in 2012, you developed a national financial inclusion strategy in Indonesia. It's 5 years later now. In your view, and also it has been selected as the country winner of the 2017 Global Inclusion Award for the Asia-Pacific region. So it's a very prestigious award. Pak Widmo, in your view, what are the lessons learned in these 5 years?
Okay, thank you, Mr. Abasades, for the invitation to this event. Actually, this is my really good opportunity really to share the experience of Indonesia in terms of the financial inclusion. But I would like not only financial inclusion, but also how the financial inclusion is in the context of the whole, initiative in the preserving, stability, stability of the financial system, and also the growth of the economy is more important. So I would like to share first about the Indonesia, without knowing how the Indonesia, demographic of Indonesia, I think it's very difficult to understand why Indonesia leading in the financial inclusion. So we'll be waiting for the slide. I would like to share, actually, the financial inclusion is one of the initiative really to support the economic growth, because I believe the growth, economic growth is very important by enlarging the opportunity of people to work, to reduce the poverty, and also really to provide more, job opportunity upon the people. Then, sorry, because that is the operational risk happen here. So, but anyway, I can share a little bit with my articulation on this. Indonesia is the island. You can imagine the island is 17,000 island. And then only Java Island is very developed, and then mostly more than 50% the growth of Indonesia is from Java Island, but the rest is very low income people, and then remote area, but not very rich with the natural resources. So I believe you can imagine the population is 250 million people in Indonesia. Then, you can imagine the island countries, rich with the natural resources, also fishery, and then also mining, agriculture is there. If you talk about the rainforest in the world, is Indonesia. You can orangutan is in Indonesia. Have you been in if you watch the movie Dinosaurs there, then we have an island, Komodo Island is really beautiful island. That is the later dinosaurs is there, Komodo Island. So rich, very rich, for everything. So then when we're talking how really to support the growth, economic growth, even with the IMF, we try to explore the engine of the growth. Each country with different style, I think one of them is financial inclusion, but of course, support growth, we have to really not to ignore about the stability, not to ignore the financial integrity, and then not to ignore about the cost of the environment. So along the way, we still, maintain the integrity, maintain the, environment-friendly development, and also we, basically to try to minimize the cost because of the growth. So we mindful about those things. We can talk in different platforms about those things. So let me focus on the financial inclusion. So actually we have this initiative. It's not just recently, because when I joined with the central bank 1980 even, we have in Indonesia not really in the articulation of financial inclusion. We have the saving program for students. We have saving program for the pension. We have saving program for, and then we have a lending program for the poor. We have lending program. But one thing that now been really help financial inclusion about the technology. Without technology, we've been experiencing difficulty really to reach out in this remote area. Very difficult. We have to present physically in the area. That's just without technology. But with this technology, it's very easy. And then the technology, the mobile phone been everywhere in Indonesia. Then using this technology, we can reach out in the remote area using technology. And then we don't need anymore to open branch bank in this remote area. No. We just use the government agency, the smallest bureaucracy in the government as our hub in the remote area. And then we can use we encourage call it the branchless banking. So when actually the commercial bank, they can use their customer in those areas as agent. And then provide technology, as the agent banking. Yeah. Then they can do similar the branch. So this kind of platform is very useful for Indonesia really to reach out the remote area. All the saving program, lending program, and then also the government support program, they can use this technology to reach those. And then we have the government support program for the healthcare, government support program for education, and also for the food, using technology, and just use this kind of the bank account. Use just with the simple electronic card, they can use for everything. So you can imagine how powerful the technology. So I believe we have a target by 2019, 75% of the financial inclusion target. I believe it's very easy to accomplish, very easy. So then, in a way that, again, Indonesia win the award upon the financial inclusion in 2017 is, I believe, because of the nature of Indonesia and technology. Actually the effort been there many years, but without technology is very, very difficult. Even now, the private sector, they also reach those areas without the government support program to offer the financial technology platform as like lending, saving, transfer, in anything, payment. So the fintech development is very huge. Then Indonesia with 250 million people is really a big opportunity for those kind of technology to help the poor people. I believe there will be close link between the poor, technology, and the growth in the end. Even now Indonesia, the growth is still steady, 5.1%. That I believe will be higher next year, and then the share of the island outside of Java Island been greater and greater. Then finally, the poverty will be lower, and finally, will be good for everybody in Indonesia. Thank you very much.
Well, thank you. I mean, it's pretty impressive given the odds of 250 million people, the challenges of having, you said, 70,000 islands. I should also mention, I know we're talking about financial inclusion, and I don't want to veer off too much from it, but we talked about the twin pillars of financial inclusion and financial stability. I know this firsthand, Ruth knows as well. Indonesia has had a lot of different programs and emphasis on financial stability, ongoing crisis simulations and everything else. So the country is taking both aspects very seriously. So Ruth, I'd like to turn to you now. Let's go across the globe to Latin America. And reflecting on your experiences in Latin America as a former central bank governor over the decades, what are your impressions of the evolution of the microfinance sector? Are the potentials being realized?
Positioning the question on the basis of the potentials, I would say that Latin America and the Caribbean has made progress, but there's still a long way to go. If we take the number of accounts of the population 15 years and over, in Latin America and the Caribbean, 51% of the population has a bank account, which is the third ranking region in the world after the OECD with 94%, and we rank similarly with Western Europe and Central Asia. But that is not enough. We made progress going from 39% in 2011 to 51% in 2014, but female population is only 49%, the poorest 41%, the young adults 37%, rural population 46%. Accounts are basically held with financial institutions. And picking up on what Pac Santoso said about mobile accounts, in Latin America, only 2% of the population have a mobile account. Let me just compare it with sub-Saharan Africa, 2%. Sub-Saharan Africa shows 12%, while bank accounts in the population are only 34%. We have less unbanked population, but minimal mobile accounts, which is where most of the innovation now lies. I would like to briefly guide you through the usage of the payment system. Credit cards and debit cards, low usage. The main use is to withdraw through ATMs in order to get cash, which tells you that people have an account to collect either the salary or the pension or the subsidies and then withdraw the money and move to cash. So you lose the banking affinity, development, etc. Only 18% of the population receive their wages through a bank account. Only 9% receive government transfers. Only 6% pay their utilities through bank accounts. The use of internet to purchase or to pay is only 7%. To send remittances, 11%. To receive remittances is even a little bit lower. Mobile phones account for 4% of the transactions. People save largely in financial institutions, 10% for old age, 10% to start a business, 17% for education. They borrow only 33% of the population, 8% has mortgages outstanding, largely from institutions, less from friends and family, low for informal lenders, which are the sharks. So where are the opportunities, and how could that potential be materialized? The banked population needs to increase, no doubt. But the use of bank accounts has to deepen. So there is a large potential in the mobile phone area, which means we need a concerted efforts and alliances with financial institutions and regulators in order to bring the population to the mobile account business. One of the big challenges, in my view, is financial literacy and trust. Because people know when they save and they have the money in their home, they know where the money is. Some trust the bank that is in their region, or their savings and loans, or their pension funds, or their credit unions. But when it comes to a mobile phone, and you're faced with new technologies, and you have the risk of losing the phone, of the phone being robbed, and your savings are there, and your family's future is there, it takes a lot of courage to move to the mobile phone. Then you find that policies are not strong enough to encourage channeling payment of wages to accounts, government transfers, payment of utilities, the use of internet. Latin America is perceived as a region, but it really is an archipelago of countries with a very complex and challenging nature, with mountains. It's where mobile technology has been developing, but to get to the rural areas and to the poor is not easy. then you have to move people from the informal sectors to the more formal payment systems that require entering into a world of formality, where you have to keep books, where you end up having to pay a tax, where you're accountable to authorities. And Latin America in general suffers from a high prevalence of informal sector activity, which means that property rights over land and movable assets is difficult, not documented. You don't have the title, you don't have access to loans, and you get into this vicious circle. So building trust, building financial literacy, and engaging the financial institutions and the mobile companies and the regulators into a cooperative working relationship is, I think, the main challenge to materialize this potential.
Thank you. You touched on a lot of interesting themes. A couple of things that stood in my mind are, like you said, building trust. And that's what financial sector regulation, at the end of the day, is about, that protection of fiduciary responsibilities. And you also alluded to property rights. So I guess that brings us to the lawyer in the house. So Dirk, unlike the other panelists who come from the regulatory and supervisory world, you bring a different perspective, a private sector, academic, corporate finance law perspective. So as you listen to these comments, you're stepping back for a second, in your view, what are the necessary conditions to ensure there's a healthy climate for sustainable financing for microfinance and financial inclusion in general?
Yeah, thanks, Babak. Well, first, I think we need to take a step back and ask why we do this. And starting with economist Schumpeter, we know that we need a financial system for two reasons. On the one hand, for the individual level, to reduce risk, provide market access, and reduce transaction costs, but also for the social level, to further sustainable growth. Because the financial system is basically the catalyst of ongoing sustainable growth, of the famous process of creative destruction. So every new invention will destroy previous ones, and we see that in the world of microfinance very well with the advent of the mobile money providers, which partly take out other intermediaries in the system. So this process is apparently working in the inclusive finance world as well. So what is missing? Well, my observation is that many people focus on the front end. So they focus on the MFIs on the ground, on client protection, and the operational dimension of MFIs and banks with this social mission. What I would like to see more focus on is maybe on what I call the back end or second in line intermediary structures, or the meso level, the entities that stand behind the MFIs. And I think it's very crucial to emphasize their role. And for the reason that they have many, many very important functions in this ecosystem. First of all, and that's the obvious function, they provide funding. And why is it important? Well, the provision of funding right now in many instances still resides on subsidies. And subsidies are subject to politicians, and we all know that depending on the political climate, there's more or less availability of that. And of course, people have to eat, yeah? And that doesn't depend on political climate. Yeah? And here, of course, it's important to basically take out the political factor and add another factor. And which factor can that be? I think to a certain extent, we can encourage private capital to be more active. But in order to make that possible, we need to have intermediaries to function as catalysts between the north, where there's an oversupply of capital, and right now in low interest rates, they're looking for opportunities, yeah? And the south, where there is opportunity. And these catalysts will not only provide funding, they will also do something very important. They will provide both monitoring and mutual learning. Monitoring is the obvious one when you provide capital. But of course, monitoring makes sure that certain bad apples fall out of the universe and the good ones will have more access to funding so that they can grow. Of course, we will have some elements where the market doesn't function perfectly, but it's the best type of steering wheel that we have long term. And mutual learning, I think, is very, very crucial. When we think right now of regulated intermediaries, they will require an advanced risk policy, an advanced risk management. They will want to have detailed risk data. So the level of quantitative finance that a northern investor likes is something that MFI is not able to provide. Those meso level, they could basically collect these data, make sure that there is actually a smooth connection between supply and demand, and at the same time, there's a mission to report back the success stories also from the south to the north. And I think for that reason, it's very, very crucial to have this meso level stronger in the focus when we deal about the future of microfinance.
Thank you. That's very interesting. So the next round of the questions are going to focus more on the global standards, the importance of global standards. And there are certain bodies that deal with insurance, banking, pensions, capital markets regulation, and they try to set up the standards, Basel Committee being one of them, probably the most famous one that you know. Let me start with Tim. Tim, in your view, is this significant that financial sector standard-setting bodies have embraced the global partnership for financial inclusion so demonstrably when the G20 has not specifically tasked them to do so? Now, remember, you're not talking to a regulatory audience here, so please decode for us the Global Partnership for Financial Inclusion and G20 and why that connection is important.
Sure. Yeah, absolutely. It's vitally important that the standard-setting bodies were not told by the G20, you have to embrace financial inclusion. I'll come back to why that's important, but let's just first take a step back. A decade ago, there was one financial sector standard-setting body that was working on inclusion, and it was the International Association of Insurance Supervisors. And insurance penetration is very, very shallow in most emerging market and developing countries. So for the insurance supervisors, it was obvious that they really had no job to do unless they could do a job of market development. And financial inclusion for insurance supervisors has always been a question of insurance market development. Today, all of the standard-setting bodies are at the table. The standard setter for banking, you mentioned the Basel Committee, the Committee on Payments and Market Infrastructures, which sets standards for payment systems. IAIS, the insurance supervisors, with us already for a decade. IOSCO, the International Organization of Securities Commissions. Who would have thought that that securities regulation matters to poor people? Well, it matters a lot. And in fact, when we get into the discussion of trends in financial inclusion, alternative ways of capital market development are one of the new great opportunities. So IOSCO is at the table. You already mentioned FATF, the Financial Action Task Force, which works to prevent money laundering and terrorist financing. Most of these organizations, and the most recent and maybe most remarkable player to come to the table is the Financial Stability Board, and I'll come back to that in a moment. Most of these organizations now have standing work streams that, if not explicitly focused on financial inclusion, at least have lots of ramifications for our work. So at the time of the financial crisis, the G20 kind of stepped in and appointed itself as the new architect of the global financial system, you could say. And they imposed a lot of mandates on the standard-setting bodies. The most dramatic of these was to set up the Financial Stability Board as an umbrella over all of the other standard-setting bodies. And candidly, I could tell you that having been there at the scene, this was not a smooth ride. These were formerly autonomous organizations that really did not take kindly to being told what to do. Basel Committee told Indonesia will be made a member of the Basel Committee. Wow, that's, wake up and take notice. So that was not how we tried to approach financial inclusion. Instead, we worked from the point of view of trying to explain to them why financial inclusion matters to them and why they matter to financial inclusion. So nobody told them they had to cooperate with the G20's Global Partnership for Financial Inclusion, but they did so because we made compelling arguments about why their issues matter to us and why our issues matter to them. Maybe I'll just take FATF as an example. So FATF tries to fight money laundering and terror financing, and they have very stringent rules that are typically over-complied with because nobody gets rewarded for bringing people into the system, but they get punished if bad apples do find their way into the financial system. Nobody until the early 2000s had thought about where is the biggest money laundering and terrorist financing risk. It's in cash. You can't trace cash. Cash is how it's possible to launder money and to finance terrorism. So every time you bring somebody into the formal system, you've stopped a channel that potentially could be used for the very purposes that FATF is set up to fight. Digitization and the rapid metamorphosis of how finance is delivered in countries across the income spectrum is also forcing a convergence of the interests of the standard-setting bodies. And increasingly, they're seeing that not just on financial inclusion, but across all of the work they do, they can't work effectively in isolation. So the GPFI, this body that the G20 established, and then we kind of reached out to them to join us voluntarily, now has become a convening platform that they very much value and that they see as maybe even important to the long-term future of their work.
Great, thank you. I mean, I think Tim is underselling himself and is being too modest. I guess for the benefit of the audience, you need to understand what standard-setting bodies really do and who are in them. Oftentimes, these are very hardcore regulators, supervisors, and they can see their work as very bloodless, like these external factors should not come into it. So get them to think about financial inclusion was not an easy thing to do. So this is actually very important, and Tim has played a very critical role in that. Now, moving to a very specific example, again, going to Indonesia, a very important country. Pak Wimbo, you for more than a decade have been an active participant and a senior Indonesian representative in various international fora, such as Financial Stability Board, Basel Committee, IMF Board of Directors. So I have two questions for you. Since you had a front seat and you participated, in your view, how robust is the quality of international collaboration between supervisors and regulators in promoting financial inclusion? Is it all talk, or are they actually doing something substantial? And more specifically, have these collaborations helped Indonesia and other countries in the ASEAN region?
Okay, thank you, Mr. Ambassador. Actually, one thing on the global fora is initially we try to minimize the regulatory arbitrage among the country. So normally in the global fora, I focus on the issue that may create, different treatment from different countries. So we need the global standard. Then, actually, why we need the global standard? I believe that one thing that if the standard in one country is more relaxed in terms of the, for instance, banking or insurance, then actually the industry in the country will have more opportunity really to grow faster, and probably the risk will be higher than other. Then the issue further again, if any bank suffering from failures, then may create disruption in other countries. So the initial thought, the standard is very important to be understood in this case. Then in the case of the crisis, on the Lehman crisis, on the 2000, is really example that the issue in the US, but the disruption is everywhere in the world. Create instability in many countries. So, including Indonesia, and then one small bank been affected by the, in trouble. It was in trouble. But when we simulation on the crisis resolution, finally we can sort it out very quickly. But actually, the issue is not in Indonesia, but everywhere, part of the world. So that is so. Finally, after the Lehman crisis, the G20 stepped up really to control, to monitor, and then to have the same commitment, really how to make standard more robust, in terms of how to prevent the stability globally. So in this, if there is some of the domestic issue that as like shown that way, because in the banking sector, they focus on the systemically important bank, not the whole bank. So the global standard will be implemented only for the systemically important bank. So why we need the global standards? Then I believe those standards, why it is very important, and I believe the discussion was really sometimes very complicated. Sometimes we have a different view, especially for the advanced country with the emerging market. Because it is the industry is typically is different. But it is finally we come up with some of the conclusion and then the commitment. Then finally we as like the IMF or World Bank or any multilateral multilateral institution in the world to concern together to monitor and the progress and the implementation and so on, including the FATF something. So that is I believe is good, and then the discussion was really fair enough, actually considering the, all part of the world. Then, and then we benefit a lot that we also raised the concern about what the specific, characteristic of individual member. So then actually fair enough, and then finally especially on the systemically important bank, initially just discussed on the global systemic, but we consider, look, even the domestic systemically important bank is very important to be considered. So this kind of the idea has been accommodated, and then the discussion was, I believe the discussion was very robust, and then finally, not really, satisfying for all members, but we have some of the, an agreement, which not really 100%, heavy to any other member, group of member, or probably to the emerging market. So it is, I believe, fair enough. Then the discussion was normally also invite the private sector, the concern, the association, and so on. So before being finalized. In terms of the financial inclusion, I believe, but the spirit being discussed there, in terms of how to explore, the global growth is very important using the financial inclusion. The financial technology is one of the tools that we can implement really to support the inclusion, the people, in the remote area and so on. But also we mindful about the risks on the technological risk, and also the cyber crime, and also about the possible, because of the low level understanding about the financial literacy, so we have to financial education is important, that kind of concern. But I believe there is no discussion globally on how the standard for the financial inclusion. But I believe if it is, probably we can, start, some of the guideline and so on, I think is good. And that, but should be, it doesn't mean that should be discussed in the as like the Basel Committee, or since there will be some the initiative from a group of people, or probably in the private sector, I think it's possible that we start, to discuss, in the high level of the FSP about the look, because of, I think, but the recognition, the importance of the financial inclusion has been there, as the engine of the growth. Then the technology been recognized as the powerful tool really to support that kind of the initiative. But there is no really global standard that been endorsed by the standard sector on the financial inclusion. Thank you.
Great, thank you. So it's interesting, these two gentlemen here are, as I'm listening to them, they're in the forefront of trying to create change from inside the system. And these two are on the outside. They can afford to be like the Che Guevara, coming down and shooting and trying to really provoke. So let me just turn to Ruth in that spirit. Sorry to set you up. You've been in the trenches of trying to build the capacity of financial sector regulators and supervisors. At the end of the day, we want to equip these agents to be able to foster innovation, but at the same time have regard for undue risk. So, in your view, do they have these international, various authorities who are responsible for financial supervision and regulation, do they have the international guidance and support to apply proper, proportionate oversight to the financial inclusion sector, to, on the one hand, encourage innovation, and on the other hand, to protect consumers and MFIs from undue risk?
Well, Babak, international regulations are important. They set a framework, and they provide anchors to national regulators and supervisors to hang on to, take what they need to promote their change on the ground. In that sense, they are helpful. But regulators at a national level face their particular set of problems. In working with financial regulators with the Toronto Centre over 20 years, we've had close contact with the people that are on the ground trying to effect change. And there we perceive there is a tension between innovation and safety and soundness. Tim said there's no contradiction. It's true, there's no contradiction. And in the end, one works in favor of the other. But implementation crosses a territory of tension. Why? Financial inclusion meets change, innovation, new products, new services, new technologies, new players, new challenges, and new risks. Financial sector regulators have to start worrying about the mobile companies, the telecoms regulators, cybersecurity, security, non-financial establishments, supermarkets, grocery stores, what have you, providing payment system services, reluctant financial institutions, and the formal versus the informal sectors of the economy. In emerging markets, often more than half of the economy is in informal activities. So you have the challenge of protecting the consumer. The poorer the people who are hurt by a crisis, the larger the risk for the supervisor. And I've seen countries where a Ponzi scheme affecting the poor led to the sacking of the financial sector supervisor, even though he was not responsible for that area, and it was not his turf, and he could never have done anything against it. But the poor, banging on the doors of Congress and the executive, protesting because their money had been stolen by a swindler, ended up cutting the head of the financial supervisor who had nothing to do with it. So obviously, they are very reluctant. So what are the challenges? First, regulatory frameworks in emerging markets are not attractive enough for innovators. There is the experiment of the regulatory sandboxes, which the audience may not be familiar with. A sandbox, as you know, is a place for children to play in the sand, be creative, build a castle. You don't like the castle, you turn it, you destroy it, you build another thing, and so forth. In some developed countries, there have been successful experiments with regulatory sandboxes, which are like incubators for financial sector regulators. This is an experiment that is worth pursuing in other countries. Then, we have risk-averse supervisors. Why? The compliance check culture is prevalent. It's easy to go into a bank, you have a checklist, you say, check, 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 the bank is okay. Doesn't matter, you turn around and go away, and risk-based supervision is not easy to implement. We've been working a lot on that at the Toronto Centre. And risk-based supervision needs to be built up and needs to build trust. So if you have this compliance check culture, you kind of feel easy. If you can't do the compliance check like you cannot do when you're working on inclusion, it's hard. Another thing, supervisors normally in our countries don't have the legal protection they need. And if you don't have the legal protection, you can end up being in jail. You can end up being sued by depositors, by shareholders, or by the government itself. So we need to focus on building up the legal protection needed also to promote financial inclusion, because then you're dealing with a different set of risks, and the political risks when the poor lose money is very important. Then we have reluctant regulated financial institutions. Why are they reluctant if they could do a business? It means large investments in new technology, normally in hard currency, in many countries difficult to come up with. It means spending on security, on cybersecurity. It means going through an uncharted territory with new compliance issues, and they just tend to be reluctant. And then there's distrust. Distrust between the regulators and the financial institutions and the non-financial, the people and their mobile phones. It needs a lot of work, perseverance, guidance, and here is where international guidance comes in again, telling our regulators, it is important, pay attention. It's a call to make international standards more assertive from our perspective. So when we talk to the international standard setting bodies, we need to sort of make them aware of the need to strengthen whatever is in their written codes about inclusion, and more so about gender inclusion, and closing the financial gap for women. But it also means that our national supervisors need to be willing to use the international standards for their inclusion work at home. The tools, you asked me about tools. Regulatory frameworks need reforms to accommodate the new needs of inclusion. And the challenge is different in common law countries and civil law countries, and here I will pass the buck to Dirk because that's his field. But in our experience, the work of regulators and supervisors in common law countries is completely different than in civil law countries. The civil law is more compliance checked. Common law is more rules-based, precedents, judicial precedents, and so forth. We need legal protection for regulators, and this whole inclusion theme means new risks. And they have to feel comfortable about it, otherwise they won't move. Rationally so. We need to be concerned about data protection, privacy, bank secrecy, cybersecurity, data management, and we have to make phones available. Phones are not cheap. They get costlier in money terms. They do provide a wealth of services, but they cost more money. So they're often not available to the population. So part of the task probably is to get the phones into the hands of the people. So we move from the international standards to the national standards, to the trust building efforts, to the availability of mobile phones for companies and cellular transmission for the mobile phone companies. So this is the whole ecosystem of financial inclusion in emerging markets, where the regulators play a critical role.
Oh, that's great. And also, just so that you don't think the conversation is really in the abstract, we noticed this. You never see a supervisor put out a press release, I caught this person or that. I mean, you just don't see that. They do get the blame. They do get fired. There's examples where supervisors can get very close to a financial crime. They get killed. I mean, Andrei Koznov of Russia got very close to in 2006, to the elements around the oligarchs. So I don't want to over-dramatize, but the point is they're working, people like Pacman Santoso and others are working in a context that can be very difficult sometimes, right? So just let's keep that in mind. And I want to go off script a little bit, and Dirk, I wonder if you have any comments on what you've heard, because I notice you trying to say a few things. Go ahead.
Yeah, thanks, Babak. Of course, we had made a script, but from now on, I have to say that there are so many things that just cross my mind. Let me start with the push towards fighting terrorism financing by bringing people into the electronic banking system. Well, on the one hand, of course, that's a very desirable step. It's not just, I think, important for financing terrorism. That's a northern concern. I think for the southern perspective, it's much more important to fight corruption. And in a way, we leave a trail when we have them in the e-banking system, and I think that's very beneficial. But on the other hand, we must be very careful that we don't throw out the baby with the water. And let me give you just one example. Did any one of you imagine what happened when the power is out for 3 days? Then e-banking is gone, because the laptop batteries and the cell phone batteries will never last more than 3 days, and that means we will have an inspired, with relying on the e-banking, and very crucial food crisis. So after 3 days, with power outage, our e-banking system is over, and that means people will starve. And that, of course, opens an entirely new way of terrorism, which is much harder to fight. It's easy to control people when they get in the plane. Of course, we control 99.99999% innocent people, and it's just a giant transaction cost. But we can fight that type of terrorism. But we cannot fight terrorism attacking landlines of power lines, in particular not when we have 70,000 islands in one country. Yeah? So my point is, we must be very careful. Simple solutions to complex problems have the propensity to fail. And of course, these supranational bodies, which are under close supervision by politics, have the pressure to deliver solutions. But sometimes the solution is simply not so simple. Yeah? And here, of course, bringing people in the e-banking system, I think, is one of the most striking elements where simple solutions have the propensity to fail. So here we need to have a balance between limiting material cash flows out of the e-banking system, but retaining sufficient cash for the daily needs of people. Yeah, and I think the current way, limiting it at 10,000 euro at least, is quite good for fighting terrorism. Maybe we need to reduce the limit a little bit to fight also the corruption dimension, but bringing it down to zero cannot be the objective of a sound policy here when we think of the full complexity of the world. Another aspect that I think I want to address, it came up from Ruth, is the regulatory sandbox. We have engaged in a study covering all sandboxes so far on the world, and we found that civil and common law doesn't matter. What really matters is expertise. When you have a regulator who is very expert, because in a lot of cases, they are willing to make good decisions deviating from the norm. When you have very little cases as a regulator, you tend to make bad decisions because you are fearful of making wrong decisions. And then you rather go for the safe card than for the good card. And that brings me maybe also to a very important thing when we think about regulation. Regulation is not so much about compliance, it's about risk control. And risks can only be assessed by people who are experts in this field. Let me give you an example. Luxembourg has 16,000 investment funds on 270 regulators just focusing on investment funds. Can you imagine what level of detail of regulatory expertise is available? For every little niche, there are already 5 cases which were there, and so they can exercise discretion in this field. Now imagine a regulator somewhere, let's say on the moon, who has never seen an investment fund, and everything is new to them, and everything is something that creates a certain level of fear. So in our study, what we could show is that the legal family doesn't matter at all. It matters what kind of expertise you have and how good your people are. And maybe another concern when it comes to the regulatory sandbox, what the sandbox is doing, it puts based on a kind of experience mix between the regulator and the supervised firm or the firm to be supervised. Some is discretion in the hands of the regulator. That may be very well when we are really sure that the regulator acts in the neutral interest of the public. It doesn't work so well when we know that the civil institutions aren't so strong and maybe some of those individuals are open for some type of side income. Yeah? Then the regulatory sandbox is not only a chance, it's also a risk. Yeah? So here, I don't think it's so easy to say that regulatory sandbox is a solution. We must carefully look at what kind of stuff do we have. Do we have good people there? Do we have sufficient experience? And do we have a clear view on the strength of the institutions on which we rely? I could go on further, but I think I leave it with that.
That's great. One comment on sandboxes, so they're very innovative, but generally speaking, sandboxes so far, at least in my perspective, have a higher degree of success for innovation when they're in countries with unitary systems of government, let's say like Singapore, versus countries that have a federal or more complex layer of structure with different governments and subnational government. Doesn't mean that it doesn't work in that sector, it's just that that's just the reality. So at this point, we do have other questions for the panelists, but I'm cognizant of the time. I would like to turn it to you. You heard a lot. I'm very interested in the kind of questions you have. Please don't be shy. Go ahead. I'm not sure if we need to pass the mic, or let me pass the mic to you and then you go ahead.
Okay. I'm Peter Seibel. I have a question referring to Santoso's presentation. And I think there's a crucial point in that message. And that is, despite all the government programs in Indonesia over the past 50 years, the inclusive finance in Indonesia is savings-based. You brought this out in the first 2 sentences of your presentation. 2 prominent examples. One is Bank Rakyat Indonesia, centrally owned bank, which has 5,000 microbanking units, which in a way is a variant of what we call microfinance institutions. They are savings-based. $14 billion in savings, $13 billion in loans outstanding. And the growth every year. On that foundation, actually, they have small and medium enterprise finance. So they're not stuck in microfinance with the micro entrepreneurs. Beyond this, there are the small and medium entrepreneurs. Now, the important thing about the savings-based here is they passed a crucial test, and that was the Asian financial crisis. The banking sector collapsed. The microbanking units were almost unaffected. And I think they saved the survival of Bank Rakyat Indonesia, which otherwise might have gone under or have merged with Bank Mandiri. Now, the second example are the rural banks. There are 2,000 so-called rural banks, which are on the central bank or OJK supervision, based on the law of 1988. Because they're savings-based, they were also virtually unaffected by the Asian financial crisis. And ever since, they've been growing and growing and growing. The important thing of the regulation, for the regulator here is that the law of 1988 says that they are not allowed to accept investments from abroad. And that really saved them, because during the Asian financial crisis, the investors withdrew the capital, and that led to the collapse of the industry and the financial and the banks in Indonesia. Not the 2,000, at that time there were 2,000 rural banks. I think the savings base, actually, and it flies right in the face of all those things that we have been propagating here. And I've been on the board for the past 10 years, actually, with our belief in the donors and in the investors. There is an alternative, and Indonesia is the example. It can be savings-based, and that means the motor is within the institutions. The Indonesians are very polite people. Actually, this is the Japanese culture in particular. They don't push that the way I do. Thank you.
Okay, thanks. Would you like to comment on that? It's a supportive comment. So.
Thank you. I believe your comment is quite right. I support, because I remember 2005, before the BRI implement the technology, even the report was not quite, the consolidated report the lag is around 3 months, and then now, with the technology, they have an online real-time, the whole operation in the region, even globally. So, been consolidated real-time. Then, how powerful is technology here is actually to monitor and also to outreach the customer. Even now, the growth of the saving, BRI is the largest in terms of the asset in Indonesia. And then the number of the customers, the largest in Indonesia. And then the operation is micro, not corporate, the micro business. Then actually not only in the saving, for BRI, also leading in the lending, micro lending. So a lot of commercial banks try to copy what the BRI is doing now. But actually it's very difficult. Some of them was unsuccessful, the private sector, in doing this. So I believe because the BRI is by design, the DNA is for the micro. So then I believe for going forward, with the technology, a few, I think common from other speaker, the challenge is the fintech. The fintech. Fintechs now, they provide the services in any way, saving, payment system, lending, and transaction. And then the fintech is not necessarily provided in the financial sector. So actually I just focus on the going forward is alarm for the financial sector. So, and then also the risk is unmonitored. You can imagine if the fintech services is provided by a company, is not financial company. Even sometimes the location is unidentified. Where they are, probably somewhere in the planet. Then, but you can save your money there with very aggressive interest rate. And then you can also borrow if you want, without any collateral, without any verification document legally, no. All virtually, Then that is the challenge going forward, even for the micro business in Indonesia. So I believe now, I think about the regulatory sandbox and everything what we are, like or dislike, I think the product has been there. And then we are not going in the capacity to really to prevent or also to really to make it not happen. Because this technology is very powerful. Then Indonesia is 200 million people. So it is a big market for the fintech. So again, that is it. There will be some of the global initiative on the fintech that has been discussed. I believe sooner or later that the standard will be very important. So we are talking not only in the financial inclusion and so on, but will be, I believe the more strategically will be fintech, A standard on the fintech is very important, And then whether we try to regulate or we just let them really just, growing naturally, every country has different view on this, So in that way, We will have an annual meeting, IMF World Bank next year in Indonesia. The fintech is one of the topic will be discussed. Then hopefully will be, I believe, all country, and without waiting for the standard, we have to come up with some policy really, how to protect the customer, how to make sure the integrity on the, and we comply with the FATF, it's very important. And then how to really to make sure the transition, the impact on the financial institution, the banking sector will be minimized. And then we encourage in Indonesia the banking sector, really financial sector, really to develop their own fintech product, to make sure that we are very happy because the bank been high regulated. And then actually we implement, we call it the controlling shareholder. If something goes wrong, the financial sector, they have to be responsible. But without those kind of regulation, the fintech will be actually high risk to maintain the stability of the financial system globally, not only in particular country, but globally. A lot of fintech been developed globally, and then they try to operate in not only in a few countries, but in the global area. Then very big enough, and then whatever it is. Even in Indonesia, we can say we can have Gojek. Gojek is basically as like motorcycle taxi, as like Uber. You can order the motorcycle taxi just using the electronic. It's cheaper. And then no people are not going to go to restaurant anymore. Just stay at home, we call it GoFood. Using the mobile telephone, just order whatever it is, food at home. And then GoPay, you can pay everything using just GoPay, And then probably will be, new go. Then it is one company. One company that can provide payment system, travel, and everything. You can invest, and then the role of the banking sector will be affected, And then finally, will be create, with the a bit root word, the disruption in the economy and also the financial system. If, we are not going to have some of the global standard on this. And then I think the GoPay, Gojek will be operated globally, possible. Will be in Luxembourg, will be probably in Brazil, across Europe. And then you cannot stop it because it is electronically, And then actually for the actually the company doesn't have any taxi, doesn't have any motorcycle, doesn't have any restaurant, but they provide some of the platform that everybody can use a taxi, you get a food, get everything. So how powerful it is. So that is more strategic, to be discussed rather than only in the financial inclusion. So that is really looking forward to discuss on this. Thank you very much.
Yeah, yesterday I was trying to order Uber in Luxembourg. I realized there's no Uber here, but in Indonesia there's more. Sorry, there's a question there and then here. Go ahead.
This is Lucia Spaggiari from Microfinance Rating. We are a specialized rating agency in financial inclusion. And we have been working in the past 5 years with the SMART campaign on the client protection certification for traditional microfinance institutions and SME banks. Now we are asking ourselves the question of how we look at fintechs, because we see, as you say, the growth, we also see the client protection risks. We are very happy to see all the efforts into adapting the regulation to these new realities that we have to work with. And I was wondering, could we potentially help in terms of SMART campaign and specialized rating agencies in, during the time that it will take to develop adequate regulation to already provide some type of comfort in client protection ratings or certifications of fintechs in emerging countries?
Thanks. In the interest of time, let me just see how many questions there are. So maybe we can use them as a group yourself. Go ahead, and then we answer. Quick.
I think my voice got loud enough. Central Bank of Nigeria. And please speed up.
Yeah, you want to use this mic?
All right.
Do you want to use this mic?
Thank you very much, Barak. I'm from Central Bank of Nigeria, and I'm privileged also to implement both technology as well as supervision. I head supervision of other financial institutions. We have 1,000 microfinance banks that engage in this subsector. We're also driving financial inclusion. But I think the middle course that the regulator should follow is the issue of risk-based approach to knowing your customer. We call it tier KYC, because the people at the lower end of the market that we want to bring on board, the people we want to include into the system, their risk is relatively small, particularly savings, which is very important to the people to bring them to the financial ecosystem that is formal. Number two, the payment. Here is where we have issue with fintech. We need to pursue risk-based license approval process. Risk-based license approval process. We started our own implementation in order to be able to address the identity issue. We introduced the central bank had to sponsor what we call bank verification number, because we have challenge with identity in Nigeria. Big country, close to 190 million people, we have challenge with the identity. So what we did was to, first of all, introduce the bank verification number to the commercial bank. Now we have moved to the other financial institution, the lower end of the market, and then we have issue with financial inclusion, because there are people at the lower end had no identity. So we needed to cascade this. We cascaded this to people who don't even have, even though we have high level of mobile penetration, over 80 million mobile penetration, more than half of our country had mobile penetration. But we still need, there are still people without mobile. There are still people who have challenges of illiteracy to bring them on board. So how do we identify these people? Because they need to be included in the financial system. They need to be included with financial system. And then Drake raised an issue of operational risk. If you bring everybody to financial system and there is a collapse of technology for 1 week or 1 month, then the poor and their money, then the central bank will be fired. So these are issues. How do we create an alternative platform? Should there be a national operational risk for the economy to continue? Because the money of these people is small, but very important. And if there are issues, they will go to the assembly.
So we need to wrap it up. Yeah, sorry. Can you please we have 3 minutes left. So what I would like to do, with 3 minutes, I just want to give a chance to the panel to address these two questions. Who wants to go first? Yeah.
I'll speak to the question of the smart campaign and fintech. We didn't launch the smart campaign until microfinance was a very mature industry, you could say, and there were structures that people could refer to understand both where the opportunity was, but also where the risks were. Just to give you a flavor for what's happening with fintech, digital lending in East Africa, Tanzania has 11 digital lending platforms right now. Only one of them comes under the regulation of the central bank. So we're really not yet at a place where we could even identify with consensus what we're talking about with fintech, and it's changing at a pace that's really, as you've heard from people who are heading regulatory agencies trying to keep up, it's mind-boggling. I would love to think that some principles of digital lending are not far away, because that's the front where I think poor people and excluded or underserved poor people are most likely to be adversely affected by fintech. But I don't think we're there yet.
Yeah. Yeah. Actually, in Indonesia, we regulate one of the fintech product. We call it the peer-to-peer lending. Been regulated already by the OJK. So actually, to make sure that the customer will be protected, and then the company who provide the P2P lending will be transparent enough, then also we can identify who responsible for that product, just in case that will be customer, lose their money or believe that they are not fair enough treating the customer. So that is the principle of those regulations has been issued. Then actually we have a high campaign on the literacy in terms of the fintech, in terms of the financial inclusion. Also the question from Nigeria, actually the education literacy will be in the continuous process. Then also people to understand about the anti-money laundering and terrorist financing is very important, the education. And then also standard is very important. So risk-based actually been implemented. I think then actually we set the standard and then we ask all the financial institutions to comply with, and then we monitor based on the risk-based. So actually we, one more that we have a model in Indonesia, we have a task force on the really how to tackle, the vital financial literacy, and also to make sure that if to protect the customer, that the task force consists of all the regulator, in terms of the, FATF, and then also, the cooperation, and then all regulator we have come up with the task force. And then actually in the fintech product, they reach out to the remote area, and then Ponzi scheme model been there. Then actually we to make sure that we protect the customer. Then the role of the OJK is also one of them is to protect the customer protection. So that way we have a complete set. So that way we have a more flexible effort in terms of to prevent this kind of. Thank you very much.
Thank you very much. So I think we heard the chime. So I'd like to ask you to give a big applause to yourself and to the speakers, please. Thank you.